Hello everyone, Tom O'Sabin coming to you from my office here at the Mothership at the University of Illinois Tax School on the campus in Urbana-Champaign, Illinois. First of all, I thought you might get a treat in seeing who I am. Maybe not a treat, but this video could be used to keep small furry creatures and hard-shell insects maybe out of your garage this holiday season. Just kidding. Let me say first and foremost, all of us want to wish you the very happiest of holidays. I wish for you peace in your lives and peace in your hearts, not just today and in the season, but always. I thought I'd also take this opportunity, instead of just having some written presentation to you, to maybe consider some of our year-end tax planning ideas as we look at the waning days of 2019. Some of the references I'm going to make are to blogs that I've done previously this year, and you can go to the tax school website to see those at your leisure. The first one I want to talk about is dealing with Qualified Opportunity Zone funds, Q zones, under Code Section 1400Z. If you go ahead and look at the blog from earlier this year, one of the things that we find is that when a taxpayer realizes a capital gain, if that capital gain is reinvested within 180 days into a Qualified Opportunity Zone fund, then the client can defer recognition of that gain all the way until they file their tax return for 2026, which would mean April 15th, 2027. Now, that being said, there's also an opportunity, if the taxpayer remains in a Q zone fund between then and now, that they could only have to pay tax on 85% of the gain they recognized. Now, the way that works is after 5 years, there's a 10% of the gain bump up. So, for example, had we reinvested a $100,000 gain, there would be a $10,000 basis step up in 5 years, which means now we only have to pay tax on $90,000. The second one is the one I'm concerned about right now. There is a 5% bump up after 7 years. So a client could pick up a total of 15%, or in our example of $100,000, $15,000 that they wouldn't have to pay tax on. Well, remember what I just said about deferral. The deferral is only until the tax return is filed for 2026. Well, if you go backwards from December 31st, 2026, you know where you are? December 31st, 2019. So that being said, if you're doing some year-end planning with your clients and they're wondering about, I want to go ahead and take that money off the table, I want to take that gain in 2019, what can I do with it? I don't want to use that money right now, but I don't want to lose the gain. Well, you could tell them, how about investing in one of these Q zone funds? I'm not recommending them, it's an alternative, but that needs to be done by December 31st if in fact they want that second bump up, the smaller of the two, because again, 7-year holding period going backwards from December 31st, 2026 would be December 31st, 2019. So let's keep that in mind. Taxpayer doesn't have to wait 180 days from the date of sale in order to reinvest the proceeds. You could be meeting with a client during these last waning days of 2019. They go ahead and close out that investment, realize that capital gain, get that money into a Q zone fund by the end of the year. Assuming that the Q zone fund is going to meet the rules going forward, then they certainly could have that second bump up that occurs in 7 years. They will have met that time frame. So that's kind of planning tip number one. The second one that I've run into a lot, and I believe you probably have too out there, is where we have clients who need to take their required minimum distributions out of their IRAs. Well, we need to get those done by December 31st for our folks who are over age 70 and a half. Now, that being said, if you don't make it, there's a 50% penalty for the amount you should have taken, so be really careful. But the other thing we talked about in some blogs earlier this year was the notion that over age 70 and a half people who have RMDs can in fact do up to $100,000 per year in what's called a qualified charitable distribution. How does it work? You're over age 70 and a half, you tell the custodian of your IRA, send this money to my qualified charity. And in the blog we did on this earlier this year, we gave you a link to the IRS website that shows qualified charities, not supported or sponsored charities or approved charities, but just that those charities are in good standing. Now, you instruct the custodian of the IRA to send the money directly to the charity. What happens? You meet your RMD requirement, unless your RMD requirement would be more than $100,000. It's not included in taxable income. There's an interesting planning tip, but there's a trade-off. You don't also receive a tax deduction for the money that went in. So getting those RMDs done or doing a qualified charitable distribution before the end of the year would also be really, really important. In that area of charities, if your client's able to itemize, I've got old tried and true methods. Clean out the closets. I wanted to put in one of my blogs that if you've got enough to itemize, go check in the closet, and let me assure you, that old pair of Sergio Valente jeans is not going to fit. You might as well give it to a charity and let someone else enjoy that clothing. We can take deductions for the clothing. Cash donations that are going to be made need to be done by the end of the year. There isn't a magical date. I get this question all the time. What's that date in January that I can make a contribution and still treat it for the previous tax year? And my answer always is December 31st. Unless there's been some tragedy somewhere in the world and IRS has extended the rules like they did when we had the Haiti disaster some years ago and they gave people till January 15th. But normally, December 31st is the drop dead date for those contributions to be made for this year. So we need to get those done. If your client has flexible spending accounts, those FSA accounts, the use it or lose it accounts, need to get those expenses incurred before the end of the year. You can wait all the way to March to reimburse yourself, but in terms of incurring the expense, you need to get that done by the end of the year. Two of my favorite clients who are also good friends of mine, one is an eye doctor and the other one is a dentist. Always busy at the end of the year. I remember calling my dentist friend and saying, hey, you want to go to a hockey game? Like right after Christmas. He goes, oh, Tom, I can't get away from the office. This is the biggest week of the year, because people are wanting to spend those dollars or incur the expenses at least so they don't lose it. Use it or lose it accounts. Those are important. You know, if you look at a lot of things online or whatever it might be, they talk about deferring income. I'm really starting to be a little bit of a convert in that I'm not so sure kicking the recognition of income, that kicking that can down the road is such a smart idea. I'm running into more and more people, and you might agree with me out there too, and you can comment when this is out there, that are we in an environment today where we're in the lowest tax rates we may ever see? So if we're going to push the recognition of income down the road, is that such a good thing? Could we in fact lose benefits or pay more tax later by waiting? Now, I know there's a time value of money and there's benefit in deferral, but does it make the most sense? The other thing I might mention is clients will call now and they're concerned about maybe their cash flow. This is an expensive time of year. Maybe they're worried about potential layoffs or expenses right after the first of the year. And they're thinking about taking money out of investments right now so they've got that cash in hand so they get that peace of mind. I often tell them, look, we're within a couple of weeks of the end of the year. If you just wait to the first business day in January, you know what you've done? You pushed off having to pay the tax for up to about 15, 16 months. Is that a good thing? I'm not foreseeing that tax rates will be higher next year, but could we buy some more time to pay the tax? So I think that's a consideration. Contributing to retirement plans. We talked about taking money out of an IRA, for example. Should we max out the 401k, the 403b accounts, solo 401ks, all of those types of investments where part of the money has to be in before the end of the year? Again, I'm not as excited about those as I was, because in TCJA, if you look at QBID, we actually are rewarded for making money. So if we've got a pension plan, which is a deduction effectively connected to a trade or business, there'll be less income, which means less QBID, but when the money comes out of that retirement plan, it'll be 100% taxable. Now, does this mean that I am not in favor of saving money for retirement? I absolutely am. But how we accomplish that goal, we may have more effective ways to accomplish the same thing we're trying to do. On the area of investments, if clients have some losing positions, certainly to sell those before the end of the year might be a good idea to either be able to take the capital loss. You know, we're capped at $3,000 or $1,500 under married filing separately of losses in excess of gains, but could we offset some of the capital gains that were recognized this year? I'm going to give you one caution, that being if your client really likes the security, I'm talking about the investment, but yet wants to go ahead and take the loss, but still wants to own the security, they need to wait 31 days before they rebuy that investment, or we're going to have a wash sale, which means we're not going to get the loss now, and we're going to be adding those costs to the basis of that replaced position. Clients will also look at placing equipment into service before the end of the year so they can write it off. So the key is not that it's paid for, but that it's placed into service. So a lot of times what we run into is that a contract has been signed, or maybe all of the financing has been done, but we don't have delivery. Now, our good friend and instructor Bob Ray has given me the definition of what placed into service means. It means in a state of readiness for use. So if your client that has that landscaping company says, I just went ahead and ordered a big dump truck, it's going to cost me $80,000. Great. When are you going to get it? Well, it's not going to be delivered till March. The argument there would be that's a 2020 expense. So just a few kind of year-end planning tips as we're looking at the waning days. I know a lot of clients are coming in and getting projections. You know what else I want you to do from a planning standpoint? You're about to face the real rat race. I've always described myself as like a gerbil on a wheel. Gotta go, gotta go, gotta go, gotta go, gotta go. Take some time for yourself and for your family. And again, from all of us here at Tax School, we wish you joyous and peaceful holidays, not just today and tomorrow, but for always. And we look forward to seeing you in 2020, either in person or maybe in videos like this. But we thank you so much for your support, and we couldn't do it without you. All the best from all of us.